friends, welcome back to your channel. Today, we are diving into an essential topic for anyone involved in finance or business management: liquidity ratios. Did you know that 60% of small businesses struggle with cash flow issues? Understanding liquidity ratios can help avoid this fate. In this video, we will explore what liquidity ratios are, the different types, how to calculate them, and their importance in assessing a company's financial health. Let's get started. So, what exactly are liquidity ratios? Liquidity ratios are financial metrics that measure a company's ability to cover its short term obligations using its most liquid assets. They are crucial for assessing a company's financial health, ensuring it can meet its immediate liabilities without facing a cash crunch. Let's have a look into various types of liquidity ratios: current ratio, quick ratio, cash ratio, basic defense interval ratio, and net working capital. Let's start with current ratio. The current ratio is one of the best known measures of short term solvency. It is the most common measure of short term liquidity. The main question this ratio addresses is: does your business have enough current assets to meet the payment schedule of its current debts with a margin of safety for possible losses in current assets? In other words, current ratio measures whether a firm has enough resources to meet its current obligations. The current ratio is calculated by dividing current assets by current liabilities. For example, if a company has $150,000 in current assets and $1 lakh in current liabilities, then the current ratio is 1.5. This indicates that there is $1.5 in assets for every $1 of liability. A current ratio of around 1.5 to 2 is typically considered healthy. Next, we have the quick ratio, also known as acid test ratio. The quick ratio is a much more conservative measure of short term liquidity than the current ratio. It helps answer the question: if all the sales revenue should disappear, could my business meet its current obligations with the readily convertible quick funds on hand? The quick ratio measures a company's ability to meet its short term obligations without relying on inventories. For instance, if our previous company has $150,000 in current assets, 20,000 in inventory, 30,000 in prepaid expenses, and 1 lakh in current liabilities, then the quick ratio will be calculated as 1. Now, let's discuss the cash ratio. The cash ratio is the most conservative liquidity ratio. It only considers cash and cash equivalents compared to current liabilities. The formula is cash and cash equivalents upon current liabilities. If our example company has $80,000 in cash and 1 lakh in current liabilities, the cash ratio will be calculated as 0.8. Now, let's introduce the basic defense interval ratio. If for some reason all the company's revenues were to suddenly cease, the basic defense interval would help determine the number of days for which the company can cover its cash expenses without the aid of additional financing. The basic defense interval ratio indicates how long a company can operate without additional revenue. It's calculated as cash plus cash equivalents plus marketable securities upon daily operating expenses. For example, if a company has 1 lakh in cash and cash equivalents, 50,000 in marketable securities and has a daily operating expenses of $10,000, its basic defense interval ratio would be 15 days. Lastly, let's discuss net working capital. Net working capital measures a company's short term financial health. It's calculated as current assets minus current liabilities. For example, if a company has 2 lakh in current assets and 1 lakh 50,000 in current liabilities, then the net working capital is 2 lakh minus 1 lakh 50,000, that is $50,000. A positive net working capital indicates good short-term financial health. Now that we have covered the types of liquidity ratios, let's understand how to use them in a comparative analysis. Liquidity ratios can vary significantly by industry. For instance, a real business might have a higher current ratio than a tech company because of the different inventory turnover rates. Benchmarking against competitors can provide insights into a company's liquidity position. It's also helpful to analyze these ratios over time to spot trends. While liquidity ratios are valuable tools, they have limitations. They don't provide a complete picture of a company's financial health. For example, a high current ratio might indicate excess inventory rather than strong liquidity. Additionally, differences in accounting policies can make comparisons difficult. In summary, liquidity ratios are crucial for assessing a company's ability to meet its short term obligations. The current ratio, quick ratio, cash ratio, basic defense interval, and net working capital each provide unique insights into financial health. I encourage you to use these ratios to evaluate your business or investment opportunities. If you have any questions or experiences to share, leave them in the comments below. Don't forget to like this video, subscribe for more finance insights, and join us next time when we will explore the other types of ratios.